Hello, everyone, and welcome to Dorsey and Whitney's webinar on recent developments, implementation of the new legal entity identification and registration requirements, and the death of LIBOR. I'd like to introduce Nick Vlietstra, a partner in Dorsey's Finance and Restructuring Group. Nick?
Thank you, Rima. Good afternoon, everyone. I am Nick Vlietstra, co-chair of Dorsey's Financial Services Regulatory Group. It's my pleasure to welcome you the January session of the Bank Counsel Roundtable, our first meeting of the Roundtable in the new year. The topics for today's program are recent developments in two important areas. The first being implementation of the new federal legal entity identification and registration requirements, and the second being what we call the death of LIBOR. Our speakers are Dorsey partners, Erin, Bryan, Joe Lynyak, Betsy Sanders Parker, and Lanyard Saperstein, all of whom I'll introduce shortly. But first, a couple of housekeeping details to go over with you very quickly. Today's program is scheduled for 60 minutes, and the materials for the presentation, as well as the attendance form, are available for download through the reminder email that went out to registrants yesterday from events@dorsey.com. As we explained in that email, you should send your completed attendance form to attendance@dorsey.com, and certificates of attendance will be sent to those who return the completed form. Also, please note that we do not expect to have time for Q&A during this presentation. If you have questions for our speakers, you are welcome to contact them directly or reach out to your usual Dorsey contact. The speaker's contact information is provided with their bios at the end of the presentation materials. Okay, with that out of the way, let me introduce today's speakers and program. Erin Bryan is a partner in the Finance and Restructuring Group at Dorsey and is co-chair of our Consumer Financial Services Group. Erin is a member of the American Bar Association Banking Law Committee and vice chair of its subcommittee for bankruptcy and workouts. Erin works out of Dorsey's Minneapolis office. Joe Lynyak is a partner in the firm's financial services practice and is a nationally known bank regulatory lawyer. He practices out of Dorsey's Washington, D.C. and Southern California offices. Betsy Sanders Parker also is a partner in the Finance and Restructuring Group at Dorsey and represents both lenders and borrowers in various aspects of commercial finance. She's based in our Minneapolis office. And finally, Lanyard Saperstein is a partner and a member of Dorsey's Financial Services Practice Group. He regularly represents U.S. and foreign financial institutions in litigation and regulatory matters, and he is based in our New York office. As I said, more detailed bios for our presenters are included at the end of your materials. I'll just turn to the agenda and we can get going. The first half of our session today will have Erin and Joe covering the proposed legal entity rules issued by FinCEN in December of 2021. They will discuss the expanded federal scheme and give an analysis of possible liability for banks and other parties under that new regime. Then in the second half, Betsy and Lanyard will discuss recent developments in the death of LIBOR, including market developments and state and federal legislative developments. And then Joe will finish the LIBOR section by discussing the Consumer Financial Protection Bureau's final consumer regulatory amendments. And with that, I will turn it over to our first speaker, Erin Bryan. Thank you.
Great, thank you, Nick. Today, I will be covering some significant recent developments in U.S. anti-money laundering laws. First, I'll provide an overview of the enactment of the Anti-Money Laundering Act of 2020, which included the Corporate Transparency Act. I'll discuss the reasons Congress enacted these new laws, how they will affect the Financial Crimes Enforcement Network, or FinCEN, some key points about how the laws will affect financial institutions in particular, the penalty framework, and the legal entity reporting requirements. Then I will take a deeper dive into the Corporate Transparency Act and FinCEN's proposed beneficial ownership information rule, including coverage and requirements. Finally, I will touch on future FinCEN rulemaking before handing it over to my colleague, Joe Lynyak, to provide some analysis on how this all works and why it matters. Next, please. The Anti-Money Laundering Act of 2020, or AMLA, was enacted on January 1st, 2021, as part of the National Defense Authorization Act for fiscal year 2021. The Corporate Transparency Act, or CTA, is one element of the AMLA. The CTA adds a new section to the Bank Secrecy Act, which requires covered entities to report beneficial ownership information at the time of formation or registration. Next, please. Congress was attempting to address a number of concerns and goals with this legislation. First, there is a data sharing component. The legislation is intended to improve coordination and information sharing among state and federal agencies tasked with enforcing AML laws and administering AML requirements. Second, the legislation is an attempt to modernize AML and other anti-terrorism laws to adapt the government and private sector response to new and emerging threats. Of course, one possible area of focus is cryptocurrency, which the prior AML framework was arguably not well suited to address. Third, the legislation is intended to encourage technological innovation and the adoption of new technology by financial institutions. It's also intended to streamline compliance for financial institutions by promoting a risk-based system of policies and procedures. And finally, the legislation establishes a new non-public beneficial ownership database for legal entities to be used by FinCEN, financial institutions, and others. This will be the primary focus of our discussion today. Next. So why now? Over the past decade, we have seen an increase in bipartisan concerns about gaps in national security, as well as law enforcement access to corporate information. In the United States, it is relatively easy to create new corporate entities with very little disclosure or transparency regarding the ownership of the entities. In addition, each state maintains its own databases for legal entities formed or registered in that jurisdiction, and we have not had any real federalization of this information up to this point in time. The result has been that some bad actors have been able to use shell companies to disguise, launder, and move illicit funds, as well as to perpetrate tax evasion and fraud. So, in creating a national database, the United States hopes to close a weak link in the integrity of the global financial system, which is important not only for domestic security purposes, but also for international relations and global financial security. Next. In furtherance of those goals, the AMLA is intended to allow greater interagency and industry cooperation. It also establishes subcommittees of the FinCEN Bank Secrecy Act Advisory Group, directs the hiring of technically proficient employees, and creates a FinCEN analytical hub to assist other agencies for AML issues. Next. The AMLA contains a significant expansion of the DOJ and Treasury's authority to subpoena foreign bank records. It covers any foreign bank that maintains a US correspondent relationship, as well as any record of a foreign bank, not just the correspondent account of the foreign bank opened in the United States. It authorizes United States banks to share suspicious activity reports and other AML-related data with their foreign branches and affiliates. Just this week, FinCEN issued a notice of proposed rulemaking to establish a pilot program for financial institutions to share suspicious activity reports with their foreign branches, subsidiaries, and affiliates. Comments on this rule are due March 28th. Notably, The AMLA also requires Treasury to coordinate with designated state bank and credit union supervisors, including to periodically publish AML and CFT policy priorities. Next. The AMLA provides a safe harbor for financial institutions that keep an account or transaction open after receiving a valid keep open request from a law enforcement agency. It imposes new fines and penalties for AML violations, although for FDIC regulated institutions, this is redundant authority because Section 8 of the FDI Act and other enforcement provisions are already more than adequate. The AMLA bars individuals from serving on boards of U.S. financial institutions for egregious AML violations. It authorizes the capture of certain profits and the clawback of bonuses for AML violations too. It criminalizes the concealment of foreign political figures involved in money laundering transactions, and it creates an expanded whistleblower protection and rewards program, which is modeled after the SEC's whistleblower program. Next. The biggest headline here, however, is the CTA, which directs the creation of a non-public federal database for the registration of legal entities. It's estimated that 2 million new legal entities are created each year in the United States. Not all of these entities will be required to report. The database is focused on smaller corporations, LLCs, and similar entities. While some industry groups have raised confidentiality concerns, access to the database will be limited to financial institutions currently subject to the legal entity requirements, the DOJ, the IRS, and certain US and foreign law enforcement authorities. The CTA also directs FinCEN to promulgate regulations implementing the beneficial ownership information reporting provisions of the CTA. Next. On December 7, 2021, FinCEN issued its proposed rule for beneficial ownership information reporting, which I'll refer to for brevity as the proposed BOI rule. The proposed BOI rule implements the beneficial ownership information reporting provisions of the CTA. The comment period closes February 7th. Next. The types of legal entities required to report include virtually every type of corporate form: corporations, LLCs, partnerships, trusts, and other legal entities. There are, however, 23 exemptions. The list of exemptions reinforces that the reporting requirement is primarily intended to target shell companies and other smaller entities without significant domestic operations. For example, an entity will be exempt if it employs more than 20 employees on a full-time basis in the United States and filed federal income tax returns in the previous year demonstrating more than 5 million in gross receipts or sales, and if it also has an operating presence at a physical office within the US. Although FinCEN could expand the list of exemptions, so far it has elected not to do so. Next. Covered legal entities will be required to register upon formation and upon a change in ownership. The CTA creates two types of reporting companies, both of which are new terms, but the meanings are intuitive: domestic reporting company and foreign reporting company. Domestic means that the entity was created by the filing of a document with a Secretary of State or similar office under the law of a state or Indian tribe. Foreign means the entity was formed outside of the US and then registered to do business in the US by filing a document with a Secretary of State or similar office under the law of a state or Indian tribe. Legal entities already in existence before the effective date of the regulation must register within 1 year of the effective date of the CTA regulations. entities created after or entering the US after the effective date of regulation must register with the FinCEN database within 14 days of their having registered with the Secretary of State or similar entity. Updates and corrections must be made within 14 days of the triggering event. Next. Reports must identify one or more company applicants. For a domestic reporting company, the company applicant is the individual who files the document that forms the entity. For a foreign reporting company, the company applicant is the individual who files the document that first registers the entity to do business in the United States. Significantly, company applicant includes anyone who directs or controls the filing of the document by another. That is extremely broad. Next. Under the CTA, a beneficial owner is any individual who meets at least one of two criteria. First, exercising substantial control over the reporting company, or second, owning or controlling at least 25% of the ownership interest of the reporting company. Reporting entities also must identify every person satisfying at least one of those two criteria. Under the CTA, whether a person has substantial control is indicated by any of the following. And this is, by the way, a non-exhaustive list. 1, service as a senior officer. 2, authority over the appointment or removal of any senior officer or dominant majority of the board of directors. And 3, direction, determination, or decision of, or substantial influence over important matters. Ownership interest is a similarly expansive concept, referring to not only equity in the reporting company, but also other types of interests, such as capital or profit interests, including partnership interests, or convertible instruments, warrants or rights, or other options or privileges to acquire equity, capital, or other interests in a reporting company. Even debt instruments are included if they enable the holder to exercise the same rights as one of the specified, as any of the specified equity or other interests that I just listed. So as you can see, this framework represents a significant expansion in the concept of beneficial ownership. Next. The information a reporting company must provide for the company applicants and beneficial owners includes the full name, birth date, and current address of each individual, a unique identifying number from a specified approved government identification document, for example, an unexpired state-issued driver's license or a passport, and an image of the document. Next. The proposed BOI rule is only the first of 3 expected proposals to implement the CTA. We await 2 subsequent proposals. A proposal to clarify what information must be reported, and a proposal to amend a lender's customer due diligence obligations. And with that, I will hand it over to my colleague, Joe Lynyak.
Thank you, Erin, and good afternoon, everyone. I hope everybody is safe, and considering what's going on with the weather in the Midwest and East, I hope everybody is warm. One of the things which is kind of unusual for a roundtable is for us to be talking about proposed regulations, but we're doing this because this is only the start of a wholesale revision to the US AML structure. And for those of you out in bank land, it might be a good idea to think about assembling a team of people to begin to monitor what's going on a regular basis, because in the case of the legal entity rule, it's probably not going to change because that was heavily negotiated between financial institutions and governmental entities when it was passed in the AML Act. As Erin mentioned, there's going to be 2 other issuances that's going to be dealing with the legal entity rule, the protocols for accessing the beneficial ownership database. For example, banks wanting to verify or maybe use it as the check for what the legal entity identification information is, and also revisions which will be necessary on an ongoing basis when the information changes. Now, two other points before we get into an analysis of some problems with the legal entity rule as proposed is that the AML Act was heavily negotiated and basically asked FinCEN and Treasury, will you please consider to make these changes? They did not order them in many cases, even though there's some FinCEN restructuring that is mandatory, but they encouraged FinCEN to do so that the Congress would not micromanage the crime enforcement posture under the AML structure. However, FinCEN has indicated clearly they are going to be looking at everything. And in fact, in December, they issued a request for information asking the public, what else do we have to change? And clearly, the due diligence, know your customer rules for banking institutions, financial institutions, which is a broader definition, is going to be affected by the legal entity proposal and final rule. And so everything effectively is on the table. Also note, just as a sidelight, which probably is concern to real estate brokers, is that FinCEN also indicated that they're also closing a loophole in that they are going to start the process of considering how to change, how to impose AML requirements on non-financed real estate transactions. So in other words, you're not going to go into Trump Tower and pay $10 million for a condo in cash without having to identify where the money came from. And that's going to radically change the real estate market. Who's going to have the obligation of doing that? We're going to have to wait and see. But for purposes of the legal entity rule, next slide, please. I want to talk about two scenarios that's going to occur and how it's going to affect most of the participants on this webinar today, meaning the lawyers, because it really may impact us significantly. And if you're dealing with transactions that involve smaller smaller entities or newly formed entities, it may impact you quite a bit. And we've got two scenarios to talk about. First of all, for existing entities. Erin mentioned the fact that FinCEN estimates that there's about 2 million legal entities that are going to be covered, that are going to be reporting entities in the United States every year. But right now, there's about 30 million that are out there that are in existence. And so they are going to have a 1-year time horizon once the rule gets finalized to send in an initial report identifying beneficial ownership and control of that covered legal entity. Probably management officials will be responsible for sending in the information. However, what also will probably be covered is, she mentioned the name of a company applicant that may be an individual at a corporate filing company, a law firm, or third party that may have some lingering responsibility or actually hard responsibility, depending upon how the proposals come out, to send in the information. And as you know, criminal liability attaches for knowingly filing a false application in front of FinCEN. And FinCEN has designed this in a manner where the entity that is supposed to be reporting should be able to identify who its ownership is. And so one question which comes up is, who is going to have the responsibility for filing these 30 million pieces of paper? And what is the degree of due diligence? Let's say you're appointed as the manager of an LLC, but you really don't know what's going higher up in your corporate structure. Also, too, within this 30 million universe of entities, significant education is going to have to take place in order to educate them and the reporting entity, whether it's a management official or a company applicant, that you've got to go ahead and do it. And how do you go about doing it properly? Maybe that will be functioned through notices that state state secretaries of states will send out on a regular basis saying you've got this obligation of filing remains to be seen. However, it does raise some really significant issues. And again, let's go on to the next slide and let's talk about where I really think in terms of law firms, the rubber is going to meet the road. This is scenario 2. A new legal entity is formed for a proposed transaction where you are corporate partner Sally or Bob, and you receive a call saying, hey, we got a new transaction here. We need you to go ahead and form a new LLC for us in anticipation of the transaction, which is going to happen 2 or 3 months down the road. We got to negotiate it, but you got to have we need one of these things in place. And so what you do is you probably call over to CT Corporation and say, hey, get this thing going, form it. And by the way, you can use some of my partners as the initial organizers in the new LLC, and that person can be a named manager. We don't have to worry at the moment about capitalization because the capitalization is going to be negotiated as part of the transaction. Well, there will be a capital contribution into this new LLC, but at the time, since you have 14 days to file this new report, information is going to be incorrect or going to be clearly incomplete. Next slide. So you have 14 days, and the beneficial ownership information may not yet exist, or at least it may exist only as to placeholders, and maybe not, and probably not in many cases, the capital structure, including potential complex capital structures that Erin mentioned, because now people are going to have to figure out what's above you in terms of corporate hierarchy. For law firms do this all the time. Law firms in Delaware do this almost on a daily basis, if not hourly basis. And the law firm attorney who is directing the creation of the new legal entity becomes the company applicant. And so a question becomes, can the filing requirement initially be delegated to the company applicant, meaning the law firm partner who is called CT, and say, hey, get this done? Must a law firm engage in some form of due diligence? What's going to be coming down the road? Now, go back to Lynyak. Following the funding and the actual structuring of transaction, you're going to have 14 days to file an amended report, including whatever ownership structure is modified or put into place. What is going to be the due diligence obligations of the law firm partner, or of the newly structured entity to file within a 14-day period? We can talk about this if we have time at the end, but we believe that this is going to require, in many instances, law firms and similar entities that regularly file, or rather organize legal entities, are going to have very, very clear representations and warranties in their agreements with their clients, indicating what the obligations are to get this done, and also lingering, what are the obligations after it's done, after initial filings have been done, and you're no longer using the law firm. Is there any lingering obligation on the part of the law firm to be able to bug you or actually file something in terms of compliance? So again, these are things we're going to have to look at, and they will probably impact all of us. And so again, an interesting analysis to be considering as these things, and as FinCEN considers the rule. I'm going to turn it now over to Lynyak.
So I hand it over to Betsy.
Since we last spoke, I think it was probably April of 2021 when I last did one of these roundtables about LIBOR replacement. A lot has happened. We can go ahead and move forward to the next slide. I was speaking then about all the certainty that we had relative to a few months earlier. And it's kind of cute actually to look back on what we felt was certainty given what we now have. So fast forward to today, and we've now seen the death of multiple LIBOR settings: UK sterling LIBOR, Swiss franc LIBOR, yen LIBOR, euro LIBOR, and also 2 tenors of USD LIBOR being the 1 week and the 2 months. So as of December 31st, 2021, those interest rates are no longer being published. As we move forward through the presentation, I do want to add one caveat to everything I'm saying. I'll generally be speaking to trends that are occurring in the bilateral and syndicated lending spaces. So there are many different perspectives and different markets to be looking at. That's the one I'll be focusing on most. I will point out a few deviations as I go through my presentation. So what remains of LIBOR? USD LIBOR will continue to be published until June of 2023. However, the banking regulators have made extremely clear that the banks may not originate any new USD LIBOR loans during that time. So all originations must have ended at the end of last year. Now, there has been some question as to what origination means. We're lawyers. We can't just take a word and go with it. What does it mean? Well, part of that answer is obvious. No more closing on new LIBOR loans. But some of it's less obvious. What about a loan that auto renews? Would that be considered a new origination? And the answer from the regulators is yes. So if you have any loans that auto renew, you'll need to get those transitioned off of LIBOR prior to that auto renewal time. What about committed loans that have not yet been advanced? Those are okay. What about uncommitted loans? Probably not permitted. Next slide, please. We have to move away from LIBOR, but what are we moving to? What benchmarks are being used instead? You've no doubt heard a lot over the course of the past year about SOFR. After the actual death of the many forms of LIBOR, this is probably the second biggest thing that happened in the last year, which is the approval and recommendation by the ARC of term SOFR as an interest rate benchmark for use in business loan activity. That's not in lieu of, but in addition to the other SOFR rates that we already knew were at our disposal prior to July of last year. Term SOFR is a formulation of SOFR, for those who don't know, that in many ways looks and feels a lot like LIBOR. So it's one reason why this approval was very much anticipated in the market. It operationally is much easier to substitute and plug and play than many of the other SOFR rates. So we can rip off the Band-Aid with a lot less pain than we might do with some of the other rates operationally. But that's not to say that the other types of SOFR and even other benchmarks don't have their place in the financial markets as well. So when I'm speaking of other benchmarks, I'm speaking here of credit sensitive rates, BSBY and others that I've listed here on the screen. They have their own benefits, and term SOFR does have its drawbacks as well. For example, it's only recommended, or I should say it's not recommended for use in most of the derivatives markets. So, you know, it does have its limitations, but as a general rule, you're going to see the various types of SOFR as the rates that are getting the most support from regulators in this space. Some institutions have, well, most institutions, I'd say, of the larger institutions have decided to go the SOFR route. There are others that have decided to go the credit sensitive rate route, and you know, that's fine. Regulators have not prohibited that course of action, but they have said that because of what they perceive as the benefits of SOFR, that being stability, robustness, and transparency, the regulators are going to give kind of special attention to those non-SOFR loans in order to make sure that the banks and institutions are really evaluating the challenges that they may present, the weaknesses, and that they have in place processes to account for those. With all this talk about SOFR and BSBY and credit sensitive rates, it's easy to forget one other old standard, which is prime. I was just saying that lenders are also switching over to use prime in many instances, and adjusting the margin to create an all-in rate that was similar to what it was at the time of the transition. Thank you. So now moving on to credit spread adjustments. There's a number of different credit spread adjustments that are going to be necessary here. So because we are switching from SOFR to, from LIBOR to SOFR, there are differences between those two rates that naturally occur due to the way that they are calculated. SOFR is a secured rate, LIBOR is an unsecured rate, so that there's going to be a delta there to account for that difference. ARC has recommended in its recommended fallback language that I'm sure many of us are familiar with by now, adjustments that align with the ISDA benchmark rate. So that's, I believe it's roughly 11, 26, and 42 basis points for the 1, 3, and 6 month LIBOR transitions tenors respectively. But there are other things to think about, particularly as we're looking at the new SOFR loans. We're seeing that banks are adopting different rates for those loans. They're not feeling tied to what the ARC recommendation is for the fallback, nor should they. The ARC has been very clear that its recommended rates are not necessarily what they would what would be required or suggested were they to suggest or require for a new loan. So what we're seeing here is there's still a credit spread adjustment component there, just to make sure that there's an economic balance between the fallback loans and the new loans. But what we're seeing here is 10 basis points generally for 1 month SOFR, 15 basis points for 3 month SOFR, and 20 basis points for 6 month SOFR. So there has been some slight movement up and down off those numbers. And we are even seeing some agreements that have just a flat CSA, regardless of the tenor, of somewhere in the range of 10, 12 basis points. So there's more than one way to do this for the new SOFR loans going forward. So then we want to look next at how the credit spread adjustments are actually being applied. You'll want to pay close attention to this when you are both drafting and reviewing loan documents to see how the components fit together. Those components being the benchmark, CSA, the margin, and then also the floor. So what we're seeing in the market here is still quite varied, and we'll need to wait a little while for the trends to appear in this area, I think. I've put up here on the list several different formulations. We'll have to pull back into our earlier days of order of operations. But as you can see, the way the floor is applied, the way the CSA is incorporated, we're seeing a fair amount of variation there. So next slide, please. We've made it to 2022, and we are only 17 months away now from the end of LIBOR. So there's still roughly $5 trillion in legacy LIBOR loans out there that will need to make their way over to SOFR or a different rate over the course of the next 17 months. So what will need to happen next? First of all, there are still many agreements out there that do not yet have hardwired fallback language. They are relying on the amendment language. Now is the time to do those amendments. Secondly, many of the hardwired fallbacks include early opt-in language. So rather than waiting until 2023, those can transition at the time that the parties agree under the language of that documentation. So there may be some documentation to do there, and also some decisions to be made about exactly when to do that. Third, for term SOFR, you'll need to obtain a license from the CME to use that rate. Really, if you're doing anything with it, aside from simply looking at it, you'll need to get a license. I think many of the other rates also, you would want to have a license in order to use those other rates. So you'll want to look into that if you have not already. And finally, make sure that your system is set up to transition from the two-part pricing that we had which was just the benchmark plus margin, LIBOR plus a margin, over now to SOFR plus the CSA plus the margin. So there's a lot there that's happened in the last 8 months or so, and we've come a long ways, but we have a fair amount yet to do. So with that, I will turn it over, I believe, to Lynyak.
Great, thanks so much, Betsy. I will be talking about state and legislative developments, and echoing and building upon what Betsy said. You know, if you look at where we were a year ago, there's certainly been a lot of significant development, including on the legislative front. And I'm going to discuss what has happened in New York and what is happening, current tense, at the federal level. So, New York. We had the then governor on April 6th last year signed into law a Senate bill and an Assembly bill that passed through the New York legislature. It is now codified in Article 18C of New York's General Obligations Law. And for those who have the website in front of them, I provided links that hopefully work to each one of those, to the bills as well as to the statute itself. I don't know about you, but certainly if you said to me last January, the New York legislature would be passing and the governor would be signing into law LIBOR legislation, I certainly wouldn't have been optimistic about the chances and would be surprised if it had made it through, but it did. And it was introduced by Senator Thomas, as well as Assembly Member Zabowski. It was overwhelmingly voted for in the New York Senate. I think there was only one senator who voted no on it. It was effective immediately. So kudos to the New York legislature for, tackling, or at least trying to tackle and make some headway with this tricky issue. The intent is to minimize the impact on parties' contractual rights and avoiding economic value transfers. And I think we all understand the real problem here is the economic one, that this is, or LIBOR transition, zero sum. And we want to get it, we want the transition to be as put the parties in the same or as close to the same economic position they were going into it. But sometimes you have the risk of, someone's going to win and someone is going to lose. And that's the nature of a zero sum game. So, but certainly the New York legislation tries to put the parties in the same position that they would be if LIBOR had continued. An obvious point, the New York legislation governs only a New York contracts or contracts governed by New York law. That's not an insignificant number of contracts, but we were talking about derivative contracts, and if you look at a master ISDA, for example, they're often governed by English law. So it would not reach those contracts, or indeed contracts governed by any other law of any other state. Whether the legislation applies to any particular contract depends on not the type of contract, but if and how the provisions in the contract deal with the LIBOR replacement, right? The fallback provisions. So what fallback provisions do the contracts have? A couple areas that the legislation doesn't impact before we get into what it does. Given the purpose of the statute, is perhaps not surprising to know that the contracts, they don't reach contracts, the legislation doesn't reach contracts where the fallback provision results in the use of a specified non-LIBOR based replacement, such as prime, federal funds rate, etc. Second, the contract, you can opt out of it, right? Even if the contract falls within the scope of the legislation, two parties or more can opt out of it. And I think one of the reasons that's there is to protect it or help protect it from constitutional challenge. And we'll get into that a little bit more in a few moments. So what does it cover? Well, it covers three types of contracts, and namely those contracts that on or after the legislation's LIBOR replacement date fall into these categories. A contract that lacks any fallback provision, and you certainly have that with the legacy contracts. I've spent much of last year slogging through many documents, and a number of these deals are certainly pre-2017, before Andrew Bailey said, you know what, we're not going to be doing this for much longer. So you have contracts with no fallback provisions. You have contracts that contain fallback provisions that lead to a LIBOR-related replacement. So, for example, last available LIBOR. And then there's contracts which require polling for interbank rates. And where you have that, and it's on the LIBOR replacement date, it's going to be the new rate is going to be the recommended benchmark rate. So there are two parts of this bill: the recommended benchmark replacement date, recommended benchmark replacement, and the replacement date. So we'll consider both of those. Recommended benchmark replacement, SOFR. Right, that is what the legislation contemplates. And I should have noted at the outset, but I'll note here, that the New York legislation is based on the ARC's legislative proposal. So it's no surprise that the New York legislation's benchmark replacement is SOFR. The ARC has already published the recommended benchmark replacements for 1 and 2 month LIBOR tenors. And I believe ARC has said that it will provide the remainder of the recommendations no later than June of this year. How about the LIBOR replacement date? Well, it's one of two things, right? Either when the LIBOR administrator says it has ceased, or the regulators have said it's ceased. Based more on the latter, we've got the LIBOR replacement date has already happened for the 1 week and 2 month US LIBOR tenors. And that was the first business day after January 31st of last year. And then the LIBOR replacement date for all other US tenors is the first business day after June 30th, 2023. It also provides a safe harbor provision where you don't have to use it, but if you use the recommended fallback rate, then you get a degree of protection under the New York statute. One of the interesting issues, I do some litigation, and I do litigation as well as the regulatory work, and I particularly interested in this. Is the New York legislation constitutional? And as you might imagine, and to Betsy's point, lawyers like to debate these things. And I know there's been, while we were preparing for today's webinar, there was a fairly lively discussion between me and Joe Lynyak as to whether the New York legislation is constitutional. I'm with the New York City Bar Association, which published I thought, an interesting and very thorough report when the New York legislation was still proposed. And I have a link to it here in the materials. Their view is that the statute would sustain a constitutional challenge. And they went through all the contract clause, taking clause, all those types of other arguments. And they pointed to the 2 points here that in their view, it would sustain a challenge. You have the opt-out provision. And then the effort is to try and, have a comparable rate as with LIBOR. And I know Joe, though, disagrees.
Well, I guess my thought is that there's a couple of issues that may interfere with the SAGE and well-schooled guys from the New York City Bar Association in that, first of all, it's evolving. And there are a number of articles that are coming out saying there are problems here. We're going to have to deal with them. I would also point out the fact that one of the difficult issues when we're talking about the different tenors of SOFR is that there are several different categories within each tenor of SOFR. There's a forward-looking SOFR, there's a backward-looking SOFR, there's a margin-adjusted SOFR, and so the question becomes, how deep do you need to go in terms of avoiding litigation? Because if you would end up picking the proper tenor, and yet there still is a basis point differentiation, do you still get out of litigation? And I think that's that's a collateral point in terms of litigation. But I also want to note one other thing, and that is for a lot of you out there that have got large loans, you're going to be adopting New York law. And New York law, the general obligation law at Chapter 5 and Section 1401 allows you to adopt New York law. And people do that all the time because we know what the New York law is, but there's a separate provision for adopting New York venue. And so you could have an anomalous result where you decide to utilize New York law and this safe harbor, and you may have somebody from Alaska deciding whether or not it's constitutional or other infirmities because you never adopted a proper venue provision. So again, it's just another part of the mishmash that we're going to have to be slogging through. Those are some thoughts.
All right, good. And the importance of completely selfishly, the idea of getting good counsel when you draft these documents. Yeah, look, that's an open issue. And I did just a search last night to see if there've been any reported decisions about any potential challenges to this legislation. And I didn't see anything. I've not heard of a groundswell of constitutional challenges. But, I think as we get closer to June 2023, we may see more activity. So I certainly don't want to be that person that, if I fall out of a building 100 floors up, and by the 90th floor, I'm like, hey, everything's fine. Nothing's happened. So we've still certainly got time. And so we will see, and I suspect there will be some challenges along the way, but that's an open issue that will be resolved. There are a couple of things that the New York statute doesn't do and cannot do, right? You have at the federal level the Trust Indenture Act, and to the extent the New York statute conflicts with that, the TIA preempts, and that is a potentially, maybe not, the largest section of contracts, but certainly a difficult subset of contracts, right? They deal with legacy financial transactions, typically those under the 33 Act, often widely held, and you don't know who the holders are. So to the extent you need consent, that's a tricky issue. Then the second one is federal income tax treatment. Right? Obviously, the state cannot deal with that. And so that's another issue that the New York legislation does not and cannot address. So what about federal legislation? Why do we have it? Well, I certainly foreshadowed it, right? There are certain things that the New York state legislature cannot do. The federal legislation is designed to, just like the New York legislation, designed to prevent a flood of litigation. It recognizes that state laws can only provide a partial solution. And obviously, the state laws cannot address the TIA or the federal tax issues. So there certainly was a need for federal action. So what's happened? Well, in the House, the bill was introduced. The New York bill served as a model for the proposed federal legislation. Recently, on December 8th, the House of Representatives passed it by a 415-9 margin, which you don't often see these days. And hats off to Representative Brad Sherman, who is the lead sponsor of this bipartisan bill. Most parts of the House bill were kept in the draft Senate bill. And I thought I would just spend a minute or two highlighting a couple of interesting points about the House bill and the couple of additions to the Senate bill. Interestingly, the section 3.4 of the House bill draws a distinction between consumer loans and non-consumer loans when it comes to conforming changes, and it gives the what they call the calculating person much more discretion when it comes to non-consumer loans. When it comes to consumer loans, very little to no discretion. So that is different from the New York bill. It contemplates, the House bill contemplates the use of SOFR with tenor spread adjustments. So it doesn't refer to term SOFR, but instead SOFR with spread adjustments. Then in terms of the differences between the House and the Senate bill, we blacklined the two bills, and it was interesting. First of all, the Senate bill has tax treatment for LIBOR transitions. You would think the House bill would, but it didn't. So they add that. That's obviously important. And second of all, the Senate bill provides for a safe harbor. So if a financial institution wants to use something other than SOFR, it can and will not be punished by the regulators for failing to use SOFR. So with that, let me hand it over to Joe, who will touch upon the CFPB.
Oh, well, thank you, Lynyak. We've only got a few minutes left, so I'm going to do this on a relatively hurried basis. Can you switch slides, please? Next slide, please. A couple of things that's occurred. The CFPB, not that they really had to, but they decided that they wanted to poke their nose in and make us crazy, decided to issue their guidance on the LIBOR transition, primarily for providing disclosures under Regulation Z for open-end and closed-end credit, examples of replacement indices that meet specified standards, guidance for replacing LIBOR and HELOCs, because as you probably remember, there's specific limitations on switching out an index and margin for HELOC loans, guidance for change in term notices, and rate evaluations when we're replacing LIBOR. Next slide. The problem is that what they did, and I wish they would just simply learn how to write English. They did a 300-page gobbledygook, almost incomprehensible final rule in which their guidance is buried throughout Regulation Z. Instead, what they could have done is they could have said, look, this is a very, very unique situation. Let's have a special appendix. Let's create a safe harbor for what you need to do in order to replace these indices. And there's guidance out there, but we are going to give you guidance and hopefully reduce liability under Regulation Z, because Regulation Z violations are not going to drive this train. But other things that they did, which again are completely goofy, they go through enormous amounts of explanations about Regulation Z, but then they say, oh yeah, by the way, loan terms are contract terms governed by state law. And so you've got to go back and read state law. And a lot of the things we're talking about may not be applicable. They also say, well, yes, and in addition, we're not going to tell you when LIBOR becomes unavailable, which then gives you the opportunity to substitute some of these indices. And again, a crucial issue, which they may have been able to help, but they didn't help because that's the way they are. Next slide. They also endorse as being substantially equivalent certain indices, certain SOFR tenors, but they specifically said we're not going to address, 1 year SOFR, which is the single most important one that has got to be talked about. They don't talk about embedded issues in the GSEs, variable rate loans. At the end of the day, the conclusion is this consumer credit has never really focused on the elimination and substitution of an index. The CFPB should not have been doing what they're doing, but you're really going to have to parse through what they did. But again, the proper replacement, notwithstanding truth in lending violations, is what's going to create your liability, not a a truth in lending claim. Well, we are just at the end, and I will turn it back over to Nick.
Thanks, Joe. Thank you also, Erin, Betsy, and Lanyard for that thoughtful presentation. Thank you to our audience for your time and interest. Again, if you have questions for our speakers, you can contact them using that contact information in your materials, or you can get in touch with your usual Dorsey relationship contact. As mentioned at the beginning of the program, you can still get the materials from the reminder email that was sent out yesterday. You can also get an attendance sheet, return that to attendance@dorsey.com. We look forward to seeing you in February. Look out for details to come on that next roundtable presentation. Thank you and have a great evening.